Hello everyone and welcome back to Chartmaster Academy. In today's lesson, we're going to take a deep dive into one of the most fundamental skills in technical analysis, identifying the trend and opening positions in alignment with that trend. This single concept has the power to transform your trading approach, reduce emotional decision making, and significantly increase the consistency of your results. Let's get started. Understanding market trends. Financial markets can move in three main ways: upward, downward, or horizontal. These movements are not random, they are structured, and each structure provides meaningful information about investor behavior, market psychology, and the underlying strength of the trend. In an uptrend, the market forms a clear pattern of higher highs and higher lows. This tells us that buyers are consistently willing to pay higher prices and confidence in the market is increasing. In a downtrend, we see lower highs and lower lows. Sellers dominate. Fear or profit taking pushes price downward, and rallies are quickly sold into. In a horizontal trend, price moves within a horizontal range. Neither buying nor selling pressure is strong enough to create a directional move. These phases often represent accumulation or distribution before a larger breakout or breakdown. Recognizing which environment you're in is one of the most important steps in trading. Your strategy must adapt to the trend type. In an uptrend, we focus mainly on buying opportunities. In a downtrend, we reduce exposure or take short positions when appropriate. In the horizontal market, we are more selective, relying on shorter term setups or waiting for a breakout. Methods for identifying trend direction. There are several effective methods traders use to determine the current trend. These include 1. Price action, 2. Moving averages, 3. Trend lines, 4. Support and resistance, 5. Trend indicators, 6. Multi-Timeframe Analysis. 1. Price action. Price action is the foundation of all technical analysis and removes noise and focuses directly on the structure of price. An uptrend creates higher lows and higher highs. A downtrend creates lower lows and lower highs. A horizontal trend creates close highs and lows. 2. Moving averages. Moving averages smooth out price fluctuations and help reveal the underlying direction of the market. Short-term averages such as the 20 EMA and 50 EMA show short-term momentum. Long-term averages such as the 100 EMA and 200 EMA help us understand the broader trend. When price is consistently above the 200 period moving average, the market is generally considered to be in a long-term uptrend. When it is below, the long-term trend is likely bearish. 3. Trend lines. Trend lines are simple yet powerful. An ascending trend line connects a series of key lows. A descending trend line connects a series of key highs. A horizontal trend line connects equal highs or lows. Trend lines often act as dynamic support or resistance areas. 4. Support and resistance. Institutions, algorithms, and retail traders all react to strong support and resistance zones. When resistance breaks, price often accelerates upward as trapped sellers exit and new buyers enter. When support breaks, downward momentum often increases. These levels give us important clues about potential trend continuation or reversal. 5. Trend indicators. Indicators such as MACD, ADX, Ichimoku, and PSAR help confirm trend strength. MACD shows momentum through moving average convergence, while ADX measures the strength of the trend. Ichimoku is used to understand the general market structure, while PSAR is used for buy-sell signals. While these indicators should not be used alone, they serve as strong confirmation tools. 6. Multi-Timeframe Analysis. This is one of the most critical components of professional trading. For example, if you see a bullish structure on the weekly chart and a pullback entry on the daily chart, you have a high probability setup aligned across multiple time horizons. Large time frames reveal the dominant direction. Small time frames provide entry triggers. Applying these concepts on real charts. Let's walk through how these techniques come together in practice. First, we zoom out and analyze the overall price structure. If the new lows form above the previous lows or the new highs form above the previous peaks, it signals the presence of an uptrend. Next, we confirm the structure using moving averages. If price remains above the 200 EMA, the probability of a sustained uptrend increases. Trend lines add visual clarity. An ascending trend line is created by connecting higher lows. They show where price may retrace to before continuing higher. If price repeatedly respects a trend line, that trend line becomes an important structural reference. In this part of the chart, it is becoming clear that prices are entering the uptrend. Once the trend direction is determined, trade entry points are determined. In an uptrend, buying opportunities generally occur in two ways. First, the price often pullbacks toward the trend line or moving average. These pullbacks are considered buying opportunities. The second is continuation formations, such as ascending triangle and cup handle patterns, where price movements are above the 200-day average. As seen in the chart, while prices move above the 200 EMA, they form a cup handle pattern, which indicates that the uptrend will continue. In our example, price remained above the 200 EMA and formed a cup and handle pattern. After the breakout, price moved higher in accordance with the depth of the pattern. The basic principle here is to always open trades in line with the trend direction. In another example, we observe how price interacts with support and resistance zones, moving averages, and trend lines. When all components align, structure, moving averages, support and resistance, and trend behavior, we develop a high probability trading opportunity. Bonus chart. Now let's take a look at the bonus chart featuring a stock from the BIST30 index. Based on its current market structure, what direction do you think the trend may take in the coming period? Share your insights in the comments section. This type of market analysis helps reinforce everything we've discussed today. Technical analysis is not about predicting the future. It is about managing probabilities, reading market structure, and making decisions aligned with the trend. The trend is your most reliable guide. When you understand the direction of the market, you no longer fight against price. You move with it. Thank you for watching. Don't forget to subscribe, activate notifications, and continue your learning journey here at Chartmaster Academy. Wishing you consistent, disciplined, and successful trading.